Hello, welcome aboard. Hey, it's Walter here, and you are here at the Naked Trading Session. And today we're going to talk about ways to manage your trades so that you can get bigger profits. And this is for me, this was one of the big deals in my trading because about a little bit more than 4 years into trading, I got to the point where I was actually making money. And when I say making money, what I mean is I wasn't losing anymore. So it was a little bit better than break even, but it was a big deal to me after 4 1/3 years, but who's counting, of doing this. So it was kind of tricky. And one of the things that became very clear to me was if I could get just a little bit bigger profitable trades, that would make all the difference in the world. Because what was happening was I had plenty of winners. They were just too small. So today what we're going to talk about 3 ways for you to get bigger winners in your trading. And I'm going to talk about kind of the philosophy of this, the math behind it, because I believe that most of trading, well, all of trading can be boiled down into 3 things. One is your trading system, which is what we're going to talk about today. 2 is the way that you manage risk, which is what we're going to talk about a lot in the small account big profits course. If you're interested in getting into that course, you can click the link somewhere around this video. I think it's below this video, you'll find it. And the last thing is psychology, which is basically how you deal with the ups and downs of your system, whether or not you are a good executor of your system or if you run into problems there. So those are the big 3. It's the system. Does it make money? Does it fit your personality? Is it something that you can do long term? 2 is the risk management. How do you set up your rules? What are you trying to achieve? What are you trying to avoid? That's all encompassed in risk. And finally is your psychology, the way that you approach your trading, and more importantly, really the way that you approach the difficult parts of trading and actually the joyous parts as well, because I find that, I don't know about you, but I usually make big mistakes when I have a really strong winning streak. That's when I'm most susceptible to making mistakes. So let's talk about this little curve right here. Now, apologies to your statistics professor, but we're going to take the bell curve and we're going to talk about the bell curve as it relates to your trading. So on the left side of the curve there, you see your winning trades. Those are all the winning trades. Now, on the right side over there are the on the left side are the losing trades, on the right side are the winning trades. So if you think about that black line in the middle, that's kind of the line of demarcation. Everything to the left there is a loser. Everything to the right is a winner. So the green ones down there at the bottom of the curve, those are the outliers. Those are the really big winners. And then the dark red there, the maroon color, or as they say in Australia, maroon. It's not maroon, it's maroon. Those ones are really terrible losers. So how do we deal with this as a trader? We have a choice. We can either just roll the dice and let the curve decide what kind of things happen to our trading capital, which is not recommended. Or we can do something like this, where we decide, you know what? I want more of the huge winners and fewer of the huge losers. Right? Don't we all? Okay. So what do? We use a stop loss, right? That's why I use a stop loss. Now you'll read things. There's a good chapter in a book about stop losses and how they really hurt the performance of trading systems. Well, that's true. If you never take a stop, it's going to be pretty good for your trading system. Of course, when you run out of margin or capital, you can't keep your underwater trades afloat, then it's bad, right? Because you don't actually have to use a stop. Your broker will just say, hey, you've been margin called, and then you lose all your money, and you might even lose more money. Your broker might send you a bill. So we want to use stops, right? For stock traders, it's a little bit different because they might be fully invested, where all of their trading capital is in different assets. And so it's a little bit different than when you're using leverage in Forex or futures or something like that. So by using this stop loss level here, this dashed line, what we're doing is we're saying, okay, we'll take some of these red ones. That's okay. That's part of the deal. But we're not going to take any of the dark red or the maroon. We're not going to take any of these maroon ones. We're just going to take the red. I don't know why that word is so funny to me. We're just going to take the red ones, and then the blue ones, we want those, and we definitely want the green ones. So what we're going to talk about right now is how are some of the practical methods that you can, what are these practical methods you can use to get collecting more of these green ones? Now, before I talk about this, this is a bit like parenting. If you have any kids or grandkids or whatever, you probably know this, that some kids, you can do some things for them. You can behave in certain ways. You can punish them or discipline them one way rather than another. And that's definitely the case with me. For example, like my little boy, if I say something the wrong way, that can really hurt him, and that can really upset him. Just saying something just slightly the wrong way, the wrong tone or whatever. Whereas with my little girl, she tosses things all over the place, and she can go hog wild and just throw everything and break things and this and that. So she needs a little bit more of a firm hand. Whereas the little boy, you can be a little bit more gentle and subtle with his discipline. So that's what's good about, once you get to know your kids, and you probably notice this from the beginning, they all have a different personality. So they all require something different. And that's exactly what we're going to talk about today, are these things, these strategies for getting out of trades, and how they're all a little bit different. They have their pluses and their minuses, and some of these might fit with what your goals are, and some of them may not. But probably one of these is going to resonate with you. That's my guess anyway. So the first one that I want to talk about, and just about the parenting thing, it's really interesting to me as a psychologist. Like, I did psychology PhD. When we were looking at the research, you've probably heard that there are different types of parenting. If you took like a child development course or something like that in psychology in university, you probably heard about, there's 3 types of parenting. There's authoritarian, which is like, I'm the king, do what I say. Authoritative, which is, you should really do what I say, otherwise there are consequences. Please do this. This is the right thing to do, right? Which is the expected or the best sort of parenting. And then there's permissive, where you're just like, yeah, whatever you want to do, those are the 3 styles. And the researchers will say things like, oh, everybody should be using authoritative. That's the best way. It has the best outcomes and all that. And all that's true. But there are certain cases where actually it turns out, like if you look at really poor neighborhoods where authoritarian, which is I'm the king, do what I say or else, that style of parenting is actually quite adaptive. If you think about it, like if you grew, like I grew up, we grew up in mobile homes, right? So like we didn't even own our mobile home, we rented it, right? So we were like really poor, but there are people, so it was kind of in the country, or not really in the city. But there are people who grew up in the city where there are gangs and drug dealers and all these things going on. And as a parent, authoritarian style of parenting, where it's like, you come in at night, I don't want you hanging around so-and-so, or he's a bad influence because he's brothers in a gang or whatever. That style of parenting can really work, and it's adaptive and it makes sense. So I just want to point that out, that just because some of these exit rules that we're going to talk about here may not be best for you, that doesn't mean that we throw them away. Like, somebody's going to find this really useful. So that's why I want to give you 3. Okay. So let's get into this right now. So the first one I want to talk about is love your book. Cool. I'm glad you like it. If you've read Naked Forex, you will know one of these. If you've read Naked Forex book, you will know one of these. The other 2 you won't know. Okay. So let's get into it. Chandelier. So Chandelier is from Alexander Elder. Alexander Elder is awesome. I loved his book. So I read his book back in 2003 or 2004, whenever, I don't know when it came out, but 2003 or 2004 is when I read it. And so let's say that we're going to use the Chandelier exit here. Let me give you an example of what this looks like. Let's say that you were selling off this kangaroo tail right here that I've marked with this red arrow. So that was your signal. It's like, yep, I'm going to sell here. I'm going to go short. I'm in. And the very next candle, it trades lower, so I'm in. It doesn't really matter what time frame this is or what market. it's all the same. So then I go, all right, my stop loss goes on the other side of my kangaroo tail. This is quite normal. This is normal kangaroo tail trading. This is the kind of thing we always do when we trade kangaroo tails, or at least I do. Which, by the way, in the Alexander Elder book, Come Into My Trading Room, not only did I learn this chandelier technique, but I also learned about kangaroo tails. He has a one page on them. He actually advocated using a stop loss midway or 2/3 of the way down the tail, but I found using a stop loss further on the tail basically is better. So that's why I use that. Typically, I rarely will use a different stop. So if you like trading kangaroo tails, this might be a trade for you. You can see it actually pulled back quite hard, but didn't stop out. And then it started selling off. It started going in the expected direction, which is great. So here's what's interesting. What you do with the chandelier, and I'll link up a spreadsheet if you want a spreadsheet for this. You can get it underneath this video. That will be something that you can have just for watching the video, and you can calculate the chandelier and all that. What happens is you get the ATR, which is the average true range. And you can use, I like to use the period 20, but you might use 10 or 5 or 30 or 50 or 100 or whatever. I use 20 period ATR, and then I take the ATR and then you multiply it by a certain amount. Now this is where it becomes up to you, and this is where your testing comes into play. If you're testing this in Forex Tester, you'll probably find that one of these multipliers is going to work well. So this is the calculation. What you do is you wait, in this case, because we're selling and the market's going lower, we wait for a new low, and then we hang the chandelier on that low. So in this chart, the ATR was 32 pips. So let's say that I was going to use a multiplier of 3. Most of the time, I think you're going to use a multiplier that starts with a 2 or a 3. I think if you use one that starts with a 1, it's usually too tight. And if it's anything like with a 4 or higher, it's usually too loose. But I could be wrong. This is just what my testing has shown. Somewhere between 2.0 and 3.9 in that range is probably going to be something that you'll get comfortable with if you want to use this technique. So you hang it right here on the low. And so then I add 32 times 3, which if my math is right, it's 106 maybe? Is that right? Or 96, sorry. 96. See, never do math on a webinar. So 96 pips away. So I hang that right there on the low, and 96 pips higher is where my stop loss is. So as the market makes new lows, my stop loss moves. It only moves when there's a new low. Okay, that's really important. Chandelier is different from other exits, where in other trailing exits, you will always see the market kind of change the stop level. Well, with the chandelier, only when you're in a sell trade, only when it makes a new low do you get a new stop level, and only when it makes a new high in a buy trade will you get a new stop level. And it stays there until you make a new low again. So this stop right here will stay until I get a new low. Now, I should have mentioned actually, why would you want to use a chandelier stop? Why? Or any sort of trailing exit. The reason why is because we want to collect these trades down here where it says huge winners. The best way to collect those, you have two choices essentially to get those trades that are down there. You can set a profit target that's highly aggressive, like 20R. If I'm risking 500 bucks, then I want to make 20 times that. I want to make $10,000 on that winner. 20R would be that. Or I can say I'm going to use a trailing exit, and that way if the market keeps going and going and going, my stop loss will keep following it, and I have a potential to collect these green trades down there. So I should have mentioned that, but I think you get the idea. So now we are in this trade right here. The chandelier is 96 pips away because we're 32. ATR is 32, so it's 32 times 3, and we're going to see what happens next. And of course, the market makes a new low again. So now we put our stop loss up there and so forth. And it trails like that. Really simple concept. As the market keeps making new lows, we keep moving our trailing exit. That is the chandelier. It's in Alexander Elder's book. Come into my trading room, where you can get the spreadsheet below this video, download that, and see how it works. And like I said, you're probably going to be testing something between 2.0 and 3.9. Somewhere in that range is kind of the sweet spot. I have found. So it's up to you. So that's basically it. And then eventually it retraces here, you can see, and it stops out the trade. So that's how the chandelier works. It will just kind of ratchet as the market goes. So if you're selling, it'll ratchet down. If you're buying, it'll ratchet higher. Pretty simple stuff. Okay. All right. Let's move into the next one. The next one is in the Naked Forex book. So if you've read Naked Forex, thank you. That's great. I hope it helps. Got a lot of really great feedback about the book. It's called the 3-bar exit. So the way the 3-bar exit's a little bit different. It still is a trailing exit, but it moves a little bit differently. I'll give you another example. Let's say, if you've seen this in some of our videos, this is what's called a reverse drop trade. The market seems to go up. It's made a new high here. It's flagged down. It's made this little flag move down. It breaks higher than the trend line. The trend line's been containing these highs here. It breaks higher than the trend line, comes back down, and gives us a little bounce or a little tiny kangaroo tail on there. Even if I don't decide to buy off that kangaroo tail, if I wait for the next candle, which is a bullish candle, and I wait to buy, I place my buy stop on the high of that, that's still okay. That's totally cool. And it would have been triggered over here on this candle. Now with the 3-bar exit, we simply put our stop loss, in the case of a buy trade, we put our stop loss below the low, the lowest low of the last 3 candles. So once the current candle closes, the stop loss is recalculated. It goes right there below the low of the last 3 candles. Like usually 2 pips or 3 pips below the lowest low of the last 3 candles. So in this case, you can see the stop loss would be right here where this red line is. If you're in a sell trade, the same thing. You put it above the high, the highest high of the last 3 candles. Okay? Here's another example. The market's moving higher. It's made a little bit of a pullback here, and you can see the stop loss will be right there. Obviously, you will move it after every candle. In most cases, it moves after every candle. Not always, but a lot of the time it will move. Here's another one. You can see it's below that 3rd candle. I'm just kind of assuming that this current candle hasn't closed yet. If it did close, we would move it up below that bearish candle right there, the colored one, right? That's what we would do, obviously, if that was going on there. And then it moves higher still and finally stops us out on that last candle because that last candle went lower than the lowest low of the last 3 candles. So that's the 3-bar. Now, let's talk about the pluses and the minuses. So the positives of the chandelier are that you can adjust it yourself and that it self-adjusts according to how volatile the market is. If the market's really volatile, the ATR is going to be wider. However, there is a drawback. If your market has been really quiet and then it breaks out and like your trading system is like a breakout system that takes advantage of that, then you might have too tight a stop if you're using chandelier. The reason why is, let's say you're using a small number in your ATR, like 10, and it's been really tight and then it breaks out. Well, that breakout doesn't really affect the ATR that much. It will eventually after 10 candles or 8 candles or what have you, but in the beginning, you're gonna have a really tight stop because your ATR is so small. If you have a small multiplier like 2.1 or something like that, then you're gonna have a really tight stop and you're going to get stopped out a lot in the beginning of the trades. So that's the drawback about that. And you can change that. You can expand your ATR to include more candles, 20, 30, 50 candles, or you can increase your multiplier to 3.7, 3.8, something like that, so that it's a little bit wider if you're using something like a breakout system. Now with the 3-bar, the 3-bar is great because when you use it, it saves you from some losers. There's no way around it. Like if you're using a loose trailing exit like the chandelier, you're going to have you're going to have more losing trades, but you're going to have some huge winners, which is really the point of having a trailing exit. Well, here's the thing with the 3-bar is it's really tight. So if the market kind of consolidates and makes one of those Darvas boxes, as we've talked about those before, right? In previous videos, if it consolidates and makes a Darvas box, you're probably going to get stopped out with the 3-bar. So you really need a strong trending market with a 3-bar. Otherwise, any sort of flag down or box consolidation, you're going to get popped out, and it's probably going to keep going without you. So it will give you a higher win rate, but it will also give you smaller winners, unfortunately. Next, we can talk about this one, which is really awesome. This is the moving average exit. I don't know why more people don't talk about this one. It's awesome. So this one, we'll look at the same example that we were talking about a minute ago, which is the 3-bar exit, and it's this little reverse drop trade here that's marked by the green trend line. So this green trend line is saying the market's been following this green trend line. If it breaks out and retouches it, which it did there, then I go long. Again, maybe you don't go long in that little candle. It's not really that nice of a signal, but the next one is clearly a bullish candle, and you could go long on top of that one. Well, here's the great thing about this. Hey, what's going on? Well, my candles are going higher, and my moving average, which in this case I'm using the 6 exponential moving average calculated on the close. This one's going higher. Here's what's interesting about this, and this is really interesting. It takes quite a bit actually to move the moving average, and your exit is when the moving average, in this case it's a buy trade, so the moving average has to slope downward. So when it consolidates or retraces, a lot of the time it'll go flat or maybe slightly up or whatever, but it usually won't go down, which is really cool. In this case, you can see it had a little pullback, a little 2-candle pullback, but it's still pointed up. Now we'll do the next one right here. It's still, look at that, it had a little flag down, and it's still pointed up. It never pointed down. And then finally you get up here to the top. See up there where the moving average actually slopes downward? That's the signal to get out. So the moving average trailing exit is, you usually use a pretty small number, like a 6 EMA or 7 EMA or whatever. I wouldn't use it on a 15 or 10 or anything. I'd use it in a single digit EMA, and you wait for it to turn down. And when it turns down, it's boom, game over. I'm going to close the trade. Pretty cool. And so what this means is a lot of these sections here, you can see it's actually sloping down here, but that was actually before the trade. You can see it slope down here too, but in that case, remember the original stop loss would have been below the kangaroo tail. So you're not really, in this case, I guess you could have taken just gotten out at a small loss because it moved down. But what I like to see is I like to see it take off. If you use this bullish candle here as your reason to go long, then you wouldn't have even done anything. You wouldn't have even been in the trade when it pointed down here. So there was a possibility that you were getting out right here at the beginning. But I think for me, I would have just used my original stop loss below the kangaroo tail. But anyway, so then it goes flat here or slightly up. It goes slightly up. And then finally here, it turns down. So in this case, on the close of that dark candle, that would have been your reason to get out. That would have been your trailing exit right there. And so it actually is the same as the 3-bar in this case, which isn't normally the case, but in this case it is. So that's another. So what are the positives and negatives of the moving average exit? Well, the good news is a lot of consolidations will be accounted for, and you'll still be able to hold on to your trade. The bad news is if it consolidates for a long time, it's going to be easier for that moving average to point down. And so like if you have like 10 candles of consolidation, you might be out of the trade. So in many cases, the chandelier might hold on to the trade there because the chandelier is kind of what I call a looser trailing exit, whereas the moving average will get you out if it just sits there and flatlines for a while. If it moves down hard, like if you're in a bullish trade, like if you're in a buy trade, I'm talking about here, obviously it's the opposite for a sell trade, right? But if you're in a buy trade and the market just kind of flatlines there for a while, it's going to be easy with a few bearish closes for that moving average to turn down a bit, and you'll be out of the trade. Whereas the chandelier, remember, is hanging on the top, on the highest high, so it's not going to move until it makes a new high. Yeah. So that's the thing. The good news is this one can get you out early on when the market turns. So the chandelier is going to give back a little bit more, but it's going to allow you to have some huge winners. The moving average is kind of in between the 3-bar. The 3-bar is super tight. It's going to get you out a lot of the time. without a loss or even a reduced loss, like a 0.4 R loss. That happens all the time when you're trading the 3-bar. So this one's kind of in between. So whereas the Chandelier can be really loosey and give you some huge winners, but a low win rate, the 3-bar will give you a high win rate, but not very many big winners. And then this one's kind of in between. The moving average one is in between. It depends obviously on which setting you use. So if you use the 4, it's going to be get you out quicker than the 7, for example. But there's, like I said, there's no way I would use like an 11 or anything like that. I don't see how that, it could work, but I haven't seen that work well for me. So I like the 6. Okay. So there you have it. So that's basically it. If you guys have any questions, I'm happy to get into those now. The important thing to point out here is that the trailing exit is a balance. Your balance between giving your trade room to move and taking quick profits. So with a profit target, you predetermined where you're going to take profits. With the trailing exit, it's open. You're allowing yourself to have those green trades, those outlier trades. The fat tail can work for you in your trading. It's the best way to improve your average winner size by using some sort of trailing exit. So that's how that works. Now, the other thing to note is that when you're using a trailing exit, especially if you're used to using like a 1-to-1 reward risk ratio, you're likely to run into a lower win rate. And even with the 3-bar, it's probably going to reduce your win rate a bit. And it's going to be difficult perhaps for you to stick with it. You might start thinking, this isn't working. Maybe I should go back to profit targets. My thinking along there is that you shouldn't look at a few trades when using a trailing exit. Look at chunks of 50 or chunks of 100. If you're looking at 100 trades, compare 100 trades with the trailing exit to 100 trades with your take profit. That's the real key here. Compare 200 take profit trades to 200 trailing exit trades. If you're doing Forex tester testing, that's the way to do that. Make sure that you're comparing chunks of trades because you need enough sample to collect those fat tail trades where the market really goes. More of those, the longer you trade, the more of those you collect, and the more your trailing exit works for you. If you do it 15 times and you go, this sucks, I'm not making any, then well, that's because you don't have enough trades. You don't have enough data to see the power of it, basically. Yeah. The other thing to point out, most traders I know, and this has been universal across the board, across the world, when I'm looking at traders, I typically see them use a stop loss too tight in the beginning of the trade and too loose at the end of the trade. So it's better if the trailing exit kind of tightens up at the end as it's going and going. Our instinct is to give it more room later on, when really we should be giving it less room as it keeps moving into profit. We should tighten it up and let it tighten, which is fine. I mean, that means using a lower moving average on the moving average exit. That means using a lower multiplier on the Chandelier exit and so forth. So that's how you do that. All right. I hope this helps, guys. I wish you very happy trading. Thanks for spending time here. I'll see you in the next video, and we'll talk about compounding in the next video, I think. See you soon. Bye. Take care.